Sherry, I wonder how you're thinking about the impact of the variant on activity and sort of the economic disruption and employees unable to work and what that does to Q1 versus the impact on supply chain and what that may do to our inflationary concerns in the coming months.
Yeah, in many ways, we're sort of starting the year in a moment of deja vu where everything sort of feels the same, but at the same time, everything's different kicking off this year. And so with regard to this particular variant, we're back to variant volatility. I think what we also understand, though, is this is a very different impact. While people are getting sick, they're not being hospitalized. And instead of government shutdowns, this is now going to rest on the shoulders of corporations and the health of their employees. And so I think we continue to see sort of selective shutdowns. Not surprising that the same sectors that were impacted in the early days of the pandemic and through Delta are being impacted right now. But these also seem to be temporary states, because the one thing that's really different is that we have vaccines. It's just whether or not there's a national appetite to deploy them. And we have a framework for iterating new vaccines based on variants. And so my advice to clients right now is what got you here won't get you there, meaning from a portfolio standpoint, you want to really look at asset allocations, stay within the U.S. stocks, start to add international emerging market and China as those economies start to heal as sort of laggers, squarely sit within large cap, strong balance sheets, where companies can deploy capital and absorb the human cost of this temporary state of this particular variant, and at the same time are embracing innovation to make their business lines less expensive and more operational, which sort of entrenches us in these themes in the pandemic, which we want to have clients stay focused on.
Oh, interesting. David, are you also sort of tightening the screens or the parameters of your framework on the assumption that 2022 will be somewhat more challenging?
I think you have to, Carl. I mean, we're coming off a 30% year in the S&P, and we're starting at a very different place, a very, very different place. A year ago, CPI inflation was at 1.1%. Today, it's at 6.8%, 570 basis points higher. You've got a Federal Reserve that is just not the same backstopping Fed that it was 30% ago. And I think that's a big deal for the stock market. It means that dips are not going to be things that the Fed pivots on that easily. And so you don't have the same kind of put structure that the Fed has operated with during this pandemic and even prior to the pandemic, given the disinflationary risks that were in place before the pandemic. And you have a Fed that's probably pretty nervous about where this inflation picture is headed. I think that's the big story for Q1 and even into Q2. Omicron's going to keep the supply chain disruptions there, which means the inflation story probably doesn't get better. The base effects stink in Q1. They get much better in Q2. So I think it's a struggle. That said, there's a lot of real positive tailwinds for stocks with lower real rates and just the recovery that's continuing. So we're more in a kind of very modest uptrade idea for the beginning of the year, and then we wait and see how this inflation and Fed policy storyline develop in the first two quarters.
All right, David. So it's David. So the Fed doesn't have your back necessarily, certainly not the same way it has. But at the same time, you don't seem sort of being willing to say sell stocks, right? I mean, you're not in that camp.
No, I can't. I mean, there's too many things that tell you that, we have low real rates. We have multiples that are probably going to continue to expand. We have great earnings. We've got, a world-class stock market. I mean, we got a place where everybody around the world wants to invest. I mean, we are the center of productivity and innovation here in the United States. So how can you short that? I don't get excited about it. I think the storyline really is, David, just one of looking through this inflation data. And if the market continues, as it did last year, to not let inflation expectations get out of hand. And we see that in the break-even inflation rates, 5-year forward, 5-year break-even inflation, which is code word for long-term inflation expectations, barely budged last year, even with spot inflation up 570 basis points. The market never believed the long-term inflation story. As long as we stay with that, which I believe we will, it's very hard to short stocks. That said, I think the upside's a lot different this year than last year.